All right, there we go. The timer has hit zero. We are ready to get going. Thank you guys who have joined us for another weekly live stream. We made it a couple minutes late tonight. For whatever reason, they made me sign back into everything, and I was sitting there with the CAPTCHA thing to verify that I'm not a robot and just clicking on fire hydrants over and over as I was trying to go live. So that was a little annoying, but we are good. We are live and we are ready to go. It's your host, me. I am also your producer. And maybe I should just have like credits at the end that just, cite myself for all the various roles of this stream. I don't know. I'm talking too much. It is Sunday night. Let's get into it. Standard presentation. You don't care about that. We care more about this. Let me get down to what happened last week. We're going to recap it like we always do. And then we are going to talk more importantly about what's going on next week. But last week, high level, did we do our job? And I think short answer, we did. We had a successful week in the sense that the S&P 500 dropped 0.25%. Nasdaq went up 0.4%, but we're a little more focused on the S&P 500 with this, and we were still kind of in line with Nasdaq. But 2 weeks in a row of outperformance against the S&P 500, we outperformed by 0.58% this past week, and then 2 weeks ago was 0.98%. So if we go to our year-to-date summary, our year-to-date performance, for whatever reason, Google Chrome has been super slow for me. It's really slowing my entire computer down. I think something's wrong. Hopefully it's not lagging the stream, but if that's the case, just let me know. Anyways, here is the money chart that we care about and are going to talk about. It's our performance versus the overall market versus the S&P 500 versus Nasdaq, and we are dead in the middle of it. We trust again that Nasdaq is probably going to fall back down at some point, so we don't want to try to get too aggressive and chase it and then consequently have us fall down as well if the market heads south. But again, we want to focus on running our own race. We've said it a million times on here. And again, what is the average return of the S&P 500 in a given year in the stock market? The answer is between 9 and 10%. And we are over 10% at this point in the year so far. So let's keep that in mind. For long-term outperformance, we're doing the job that we need to do. We're not blowing anything out of the water, but one other thing that I think is so important to address is this idea of risk-adjusted returns. If we had been leveraging our account up, going crazy, and we only had 10% when the market was up like this, that would be a problem. But I think what's great and what we could always fall back on for a little bit of comfort with this strategy is we're very low on a fully cash secured basis on a week-to-week basis. So if I zoom in a little bit, last week we were 32.62%. Going into next week, we're not 54%. That is wrong. We could calculate that a little bit later. But like 2 weeks ago, 42%. We got a little bit higher, 28. We rarely use more than 35 to 40% of our account at a given point in time. And why is that? The answer is because if we take a look at the S&P 500 using the ETF SPY, on a 1 year basis, we're kind of in no man's land with RSI. Come on, please work as fast as I can talk. There we go. RSI is the big technical indicator that we use to try to figure out where we think the market may or may not be going in the near future. And as of right now, it's at 52.95. 50 on the money is dead flat, right? It's neither oversold nor overbought. We like to start to scale in to play the other side when things get overbought or oversold, but right now it's neither. And it, hasn't been above 60 or below 40 really since the end of April. So we're kind of just sitting back waiting for the market to make a move. And we've set ourselves up in such a way where, we're not taking on too much risk. What's great about this is as we sit back, as we wait, we'll collect 0.5% maybe per week, 0.33. We were at 0.33 last week. We're on track for 1.15, what we have set up for base profit this week. But if you look at what we've done so far this year and over the last, 10 or so weeks, we are currently, and we don't include this because this is the upcoming week that hasn't finished yet, we're currently on a 9-week winning streak. So that's the idea, right? If the market doesn't give us an opportunity to react to it, what we want to make sure we're doing is sitting back and collecting money via all the option premium that we sell in the meantime. So, big picture, if the market's, jumping around like this within a very, very tight range, nothing's really happening. It's not really running up. It's not really falling back down. We're sitting here as the market, kind of sputters out, and we're still collecting money. That's what we see with this blue curve. This is our profit curve. We're moving up as the market is staying flat. And that is what long-term outperformance looks like. And again, long-term perspective since July 20th, since we've been publicly tracking this stuff, we're crushing it, right? So continue to stay on this path. What we really, really want to avoid, and we say this every single week, and I can't repeat it enough because it's a very, very important part of our strategy. 2023, the focus is on not taking a big step back. We've seen in 21, maybe not so much 21, but in 20 and 22, we had some large steps back, and it's so difficult to dig yourself and kind of a little bit demoralizing to try to dig yourself out of these larger holes, as opposed to just steady building and not really taking a step back. We had one little hiccup this year, but it really pales in comparison to some of these bigger drop-offs that we had in 22. And again, when the market does start to fall back down, if it does, and I mean, the next dip in the market is always right around the corner. That's the mentality that we want to take into the market. But if/when it does occur, that's when we want to start scaling into things and getting a little riskier. The issue is we were fully scaled in at this point in time, and then when the market dipped, we got crushed. So the idea right now is as the market either kind of sputters out or even pulls back a little bit, we're barely into some of these positions to a point where we can still profit. We're still making money this year, right? We're hanging with the market. But as you can see, when the market falls back down like we saw in February and March, we saw in the S&P 500, we saw it in NASDAQ, look at our profit curve over that similar time frame. We can make up ground very quickly by outperforming on the dips, and that's kind of how we're built to operate right now. We saw at one point we were underperforming NASDAQ by 10% and the S&P 500 by 3%, and that dip we just showed on the chart got us to 4% outperformance and 1.56% underperformance on NASDAQ. So anytime we see some sort of dip, we're going to make up some serious ground. What we're giving back in return is the fact that we're probably not going to rip a 2 or 3% week off if the market does rip 2 or 3%, but we live with that with the peace of mind that we're going to be able to better conserve our capital, live to trade tomorrow, and continue to build on the progress, not just that we've made this year, but the progress that we've been making since we started this thing almost 3 full years ago. So that's kind of big picture. Let's talk a little bit about some of the individual trades because I think there's definitely some interesting stuff, right? We made a profit of $629, and we did it on a week when the S&P 500 was red. In a vacuum, that's fantastic. That's what we like to see. I really don't have too much more to say about that. So, top to bottom, Macy's wasn't too interesting. Peloton, a great example of why we like to close trades early. What we did Peloton early in the week, got up to 824, and we said, you know what? There really isn't a whole lot of extra money we can make out of this, maybe 60 to 70-ish dollars. But if you're in a position where you could take a profit of $225 on, I think it was like a Tuesday morning, and leave 60, 70 on the table, we do that every time. And why do we do that? It's because the only guarantee in the market is what is in front of you right at that second in time. And right at that second in time, we had the opportunity to take profit on those positions. So if we take a look at, kind of burying the lead here, spoiler, if we take a look at Peloton, let's talk about why this was a great idea. When we go to the 5-day chart, look what happened, right? This is Tuesday morning. It was, or maybe we did it Monday afternoon. We must have done it Monday afternoon when it was at 8:24. So we said, let's get out. It's a Monday. Let's take that profit and let's keep moving. And we don't have to think about it again. And, you open your eyes, you look at your watch list, it's Thursday morning, and all of a sudden Peloton's at 6:45 pre-market and finishes the week under 7. So that was a trade right there where we made $225 on it that week. But if we had held on and Peloton dipped down below 7, that would have been a $300-$400 difference in our account. So it's so important with some of these stocks to take profit early in the week. That's the big picture right here. Zscaler been very good to us. That one popped up big time. We made $98 off that, combined with the 140 we made 2 weeks ago. That's $238 of very low effort profit. And again, that's one of those trades that we found using our scanners that we love to use in Thinkorswim over here on this scan tab. And we'll get into some of those scanners a little bit later in the show. But again, a great demonstration of the value we get from those targeted option scans. Penn, this one kind of stunk. I don't really have the trade breakout tab, and it might be a more useful discussion if I had that in front of us. But let's talk big picture about what's going on with Penn, right? We know that when we start these positions, we want to start with the half size position. We've got like a YouTube short, TikTok kind of thing demonstrating what we did with the firm a couple weeks ago and how it's so effective. So I'll probably drop that one Tuesday. Be on the lookout for that potentially. But it's just going to explain what we're about to talk through in the next 2 or 3 minutes right here. And what we'll see with Penn is we sold the 26 strike put, and we sold it for 60 cents. We knew that we wanted a piece of Penn. We hadn't really had a position it the week before, so we were going to initiate. And when we initiate a position, what do? We want to start with a half-sized position. So for us, that was 3 contracts, and then we'd scale into a full 6 contracts, if it started to move against us. And spoiler alert, that's exactly what happened. So what we're looking at is a $252 loss on paper right now. So here's the deal. Why did we do what we do? Why did we scale in? And the answer is because if we started with 6 of these, that's a $456 loss. If we started with a full size position off the bat, it's a really, really large loss. In fact, it's twice as large of a loss for us right there. So what we do is we start with the half size position, and what that does, as demonstrated right here with the 252 loss versus that 400 whatever loss that was, it gets us in at a little bit lower break even. So we could start with the handy dandy system calculator here. We'll pull this thing up and, painstakingly calculate our break even prices. Let's pull the pen chart up and kind of talk about what happened on a 5-day basis right here. And boom, this is really where it went poor. On Tuesday afternoon, this thing popped up. And remember, our puts that we sold were at 26. We sold 26 strike puts. We sold those things for 60 cents a premium. That's a 24.40 break even price off the bat. So 24.40 on the chart right here, or excuse me, 25.40 is right about here. So Tuesday afternoon, this was max profit. We were looking pretty good. There was this big candle where there was news that I think Dave Portnoy purchased a lot of Penn shares because that's the company that's heavily invested in Barstool. But that's kind of beside the point. The bigger picture is that it popped up and we were looking good. So this could have been an opportunity for us to take a little bit of profit. We did not do that. And the trade progressed as it did. So the very next morning, it went from 26.91. It was looking great at open. And like before noon, it was 11 a.m. This thing got down to 25.40. And what do we know about when it gets down to that break-even price the first time? What do? The answer is nothing right off the bat because it could bounce off. It could hang out here for a little bit and then recover. And either of those scenarios, we either break even or make money. So what we're trying to do is avoid losing money on any individual trade. So right when we get here, we don't want to get over aggressive and scale in right off the bat. But we waited a little bit, and as we waited, it continued further down. In fact, it got down to 25-ish. I think this is about the level where we decided to double down. And why do we like that double down? Why do we think that double down is so effective? Because this 25.40 price level, that was our break-even price, is going to be lowered cent for cent, right? So we started with the 26 strike put. We sold that thing for 60 cents a premium. We had that 25.40 break-even price, and then we added the 25 strike puts for 36 cents of premium minus 0.36. So all of a sudden, our break-even price goes down to 25.04, which at the time was exactly where the stock was trading. And that's why this is so effective, right? Because on a Wednesday, and this Wednesday is when this big dip happened, we were able to take our break-even price from, it was below where the stock started at. The stock started up at like 26.60, so it was already a decently sized dip. But we took an already conservative break-even price even further down and got to, this right here, right? So in a nutshell, we're looking at this on a 3-day basis, and we were able to scale in with that double down and get our break-even price right where the chart was. Now, as fate would have it, it went down, went back up, and kind of petered out by the end of the week and finished down here at a low of 24.60, which is very, very annoying. But of course, with this strategy, we've got a contingency plan for everything. So while our break-even price was 25.04 going into last week, or at the end of last week, we rolled the position into the following week. We started last week with the half size, we scale into full size, and now we continue that full size position into the following week. So what happens here is we end up with 300 shares of Penn and then 3 cash secured puts. Why is that? Because this second piece that we look at right here, this 25 strike put, we almost want to treat that like its own individual trade. And what do we want to do with these individual trades when stocks move against us? The answer is roll them down and roll them out for a credit. So we closed this for 44 cents. We rolled from a 25 strike to a 24.5 strike, and we opened it for 53. Again, that 53 cent credit that we opened for is larger than the 44 cent debit that we closed for. So that's going to lower our break-even price on that portion individually by 50 cents plus the credit of 9 cents. So a 59 cent decrease in break-even price. Now that's going to work in conjunction with this, where we sold some 25 strike calls for 41 cents. And these are covered calls again on the 300 shares, which we were assigned from the first part of that, the 26 strike puts. So an easy way to look at this without trying to put all these legs in here and calculate, okay, how much did my break-even price decrease from this trade to this trade? A great way to do this is say, look, we lost $252 on Penn last week. What does Penn need to be at for us to make $252 back? And the answer is, as it currently sits at $24.64, we're $30 in the green. So these trades where we started with the half size position, we scaled into a full size position, and then we rolled that into the following week, 24.64 is now above our break-even price. And I think, quickly, if we just sum up all of these right here, what do we have to do to get this to equal to 252? And the answer is maybe 24.60. No, probably 24.5. Bear with me for the guess and check here. So 24.54 is about, there we go, it's on the money. 24.54 is our new break-even price. This is our weekly one, but our overall break-even price is now 24.54, which is all the way down here. So we started to trade on a stock at 26.60-ish, and over the course of a week, we worked ourselves into a full-size position. As it decreased, we worked our break-even price down from 25.40 to 25.04. And then as we got to the end of the week and it continued to skid, we were able to roll that full-size position forward to get our break-even price ultimately down to 24.54, which is lower than the stock closed at. And the great part about this, right, is that if Penn jumps back up to 25 or something like that, all of a sudden, we're looking at a profit of 390 in just this individual week, which nets out to an overall profit of $138. And look, $138 over the course of 2 weeks, it's not going to knock your socks off. It's nothing crazy. But objectively, if you have a 5-day chart that looks like this, and you have exclusively bullish positions, and you make money off of that setup, you are going to be very, very successful way more often than not in this market. So that's the idea right here. Again, we have all sorts of different trades that move in our direction. We don't even need to talk twice about them, right? But it's about managing these losers. And if we could turn something that's a loser one week into a winner overall the next week, that pays huge dividends in our week over week, which in turn our month over month, year over year, long-term performance in the stock market. It's going to look great. So that's the idea there with Penn. And let's update this formula to get it back to what the stock is currently trading at. And there you go. So that's a little bit of a preview into what's going on next week. So the other thing that I think might be useful to talk about here is going to be what we did with Shake Shack. And this might be a little bit more complex. So feel free to just tell me to shut up if this is like just not making sense and I sound like I'm rambling, because this may be something that's better explained with some diagrams, but I'll give it a shot real quick. We started Shake Shack by selling 4 65-67 strike calls. It did not go very well for us off the bat, but spoiler alert, what you'll figure out is by the end of this thing, we only lost $86, and similarly to Penn, we rolled it into next week where we'll be up $200 overall should it finish under 67. But how did we get to that point? There's a very, very key trade, and it's this one right here. So what we did is what we would consider taking the top off of a spread. Petty Bourgeois cracking the seal on the chat. What's going on? Welcome aboard. For whatever reason, my little widgets aren't working. I'm probably going to have to redo it. That's annoying, but whatever. The chat normally pops up on the screen, but good to see you. Welcome. Anyways, we started this Shake Shack call credit spread, 65-67 strike call, and we sold it for 60 cents. So our break-even price was 65, the short leg, plus 60 cents credit, 65.60. And you might say, why is your break-even price 65 plus 60? On Penn, it was just, the strike minus it. And the answer is because this is a bearish trade, right? These are calls, whereas Penn was puts. With puts, we want the stock to go up. We want our break-even price to be lower. With calls, we want the stock to go down, and we want our break-even price to be higher. So we kind of play the opposite game here, where we talked about Penn, how we kept lowering our break-even price trade after trade after trade. If we go to Shake Shack here, ticker SHAK, what we're going to see is an exercise where we try to raise the break-even week over week after week, or day after day. So big picture, why did we enter into this? The answer is on a one-year basis, Shake Shack was overbought. It got up to about a 74-75 RSI on a one-year basis. And why do we love RSI as an indicator of when something's going to pull back? Because of this little move you see here on the back end of last week. Yes, Shake Shack had good earnings, and it can continue to run higher. But typically, these things respect RSI, at least on a shorter-term basis. And with us trading week to week, these are shorter-term basis trades. So what we did was we said, hey, it's here. Let's play it down. We'll start it with the basis of 65.60 and see what happens from there. Good question from Petty Bourgeois. In our lower IV environment right now, what do you think about selling Jade Lizards, which is, a call credit spread on top of the usual cash secured put? To me, I'm not a big fan of those because when you have a cash secured put, you likely have some sort of bullish thesis on a stock. The most annoying thing in the world is when you try to get a little bit fancier with something like that and you end up in a situation where you were correct and the stock shoots up, but it shoots up so much that like your little hedge that you tried to use to protect yourself on the downside, which in this case would be the call credit spread on the Jade Lizard, makes you end up losing money, or at least takes a chunk out of your profits. So unless you have something you're truly neutral on, I really like leaving one end of the trade open-ended. So that's kind of my opinion on those. But anyways, back to Shake Shack. 5-day chart. We started this thing with the break-even price of, let's remove the drawing, 65.60. Now what's annoying about this one is we opened it the Friday before. So it continued to run up the Friday before, and you'll kind of see it right here. Yeah, this was that Friday. We opened it like right around here, and then it kept running on us. So by Monday, our cushion was almost gone, right? Anything above here, we lose money. Anything below here, we make money. And on Monday and Tuesday, it ran above it. But what do we remember about our credit spread? The first and most important part about this is the fact that our credit spread is created by two different options. The 65 strike calls, which we sell short, that's where we derive our profit from, and then the 67 strike calls, which we buy long behind it to create defined risk and create the credit spread position. So we had a strike at 65 and a strike at 67. So what I propose to do with this, when our break-even price is breached and it's a Monday or a Tuesday, just sit back and wait. Because if something crazy happens, you are really going to regret the fact that you tried to roll up or do something crazy to manage it on a Monday or a Tuesday. And if anything crazy does happen, you've still got the 67 strike call behind it. It's a defined risk trade, and we're going to be looking just fine. So hang tight and wait. And the one moment that I think you should wait for, Yeti4K in the Twitch chat asking about the MULN puts. I'll take a look at those right after this. I will not forget about that. Appreciate the comment. But what I propose with the 65-67 strike credit spread is to say, hey, we're in a position where we would lose money right now, but 4 days, 5 days left in the market is a lot of time. So just sit back, don't do anything crazy, and wait. A lot of the time when I lose money on trades, I look back and I say, you know what? I didn't necessarily panic, but I tried to do too much. I tried to get too fancy, and that's kind of what cost me in the end. But again, these credit spreads, with them being defined risk, afford you a little bit of time. So what I say is, hey, we purchased the 65 strike call behind it. Let's wait until 67 is breached to do anything. And what I propose to do with the breach is close the 67 strike call. And you may say, okay, HT, this is maybe a little bit risky. And you'd be right, because what it does is it creates a naked call position. And there are a couple things that I want to verify with this stock before doing something like that. The first of which is when I zoom out and look at it on a 1 year basis, are there any like insane rips? The answer is no. And you may say, oh, but look, it ran from like 40 to 56. That's not necessarily what I'm talking about. Like if I look at Bed Bath & Beyond, oops, I got to put a Q on it now. This is what I'm talking about. I don't want anything where the stock went like 6x or even like 2x, to be honest with you, in a very short time frame. Anything squeezy like that, that's where the naked calls can get very dangerous. Shack on a 1 year basis does not look like that. So I was comfortable with that to create that naked call position. And to make it even safer, we sold 4 of these things. We only took the top off of half at a time. Because if we take the top off half, we could benefit if it goes back down. But if it keeps running up, we're going to regret having, taking the top off all of them. So I still wanted that little plan C in my back pocket to say, hey, if it continues to run, then I'll close the final 2. But again, big picture here with the credit spread, when something runs against you, you're going to be losing money on the credit spread. But of course, there's 2 pieces on the credit spread like we talked about before. There's the short 65 call that we sold that we were trying to make money off of, but is losing money at this point in time. And then of course, there's the 67 strike call that we bought behind it, which is making money. However, the amount of money that's making is less than the amount of money that the first one is losing. So we're in an overall loss position. However, what we can do is take advantage of a massive amount of extrinsic value on the 67 strike calls. So on Wednesday morning, as this thing ran up past 67, we were able to actually close 2 67 strike calls for $1.20, which was fantastic. And what that does is we were able to take $176 of profit on that long leg and say, hey, we thought this thing was overbought before, and it kept running. So if we thought that thing was overbought before, it continued to run, we must think it is just over the moon right now as far as just where that stock price is sitting. And short term, we were correct. We took the top off and it slid back down. By the end of the day, what I was able to do actually was buy it back. So we mentioned that we create a little bit of risk by taking the top off and creating a temporary naked call position. what you could do is wait for the value on that long call to get crushed and then buy it back. You put yourself right back in that initial position. So what it did was, it cost 66 bucks, $66 for us to do that. But again, we get back into that defined risk position. So you avoid anything too risky. And the great part about this is that this thing effectively finished at $1.25 when we closed it and rolled it. However, if we kept 4 of these, we would have lost $260, as we can see right there. But thanks to what we did, the 2 that we left open lost 130, but the new one, the short leg, lost 66, and the long leg that we closed made 176. Now, when we recovered it, we lost 66 more, but that's okay. It's a loss of 86, and a loss of 86 is manageable because we could then go into the next week and say, hey, we were just playing Shake Shack to stay below 65.60. We lost $86 doing that. And since the price is still elevated, we think it has potential to continue to come back down. So we go into next week with a very similar position where, last week again, we were playing it below 65.60. We're now in a position where we could sell a 67 short leg call credit spreads for 70 cents. In all, we lost $86 on that Shake Shack position last week. Now, if it stays under 67, guess what? We are going to make $280, and it's an overall gain of $194. So despite the fact, if we look at this on a 10-day basis, that we entered this thing right here, a bearish trade, and it continued to run against us, breached our short leg on the credit spread, we were able to manage that quickly by taking the top off of half of the credit spread, rolling into next week, and now we're in our situation where, this was our initial break-even price. Now this is max profit right here. Just moving that break even higher and higher as each week progresses. And that's how you continue to manage these trades. Question from Yeti4K, wondering about thoughts on the MULN 119. I'll put this on, for whatever reason it's not working, but I'll put the chat on screen. Thoughts on the MULN, I think that's Mullen Auto Company. 119, probably thinking 519. The puts look interesting. Let's take a look. And the first thing about MULN is I know it's a very, very risky stock. So you see it at 127. Again, we want to start small with some of these things and then zoom back as we analyze these stocks. We go to the 1-year chart and boom, there you see it. The thing had a reverse split. It's really been leaking lately. It wasn't actually trading at this. It was trading lower than the reverse split, went back up, fell back down. But anytime you see a stock like this, it's obviously dangerous. When we talk about RSI, it's in the blue. That's what we like from an entry perspective. And if we take a look at the 519 cash secured puts as suggested, what's interesting is you might see 3 or 4 cents of credit and say, that's not a lot. But if you think about it, a 1 strike is such a small position that it's a 3.63% return on risk. So, it's a decent, I got to be honest, that's a decent little return right there. However, the big issue is what happens if this thing continues to, shit the bed, so to speak. If we look at it on a 20-day basis, they had the reverse split. It fell. Even on a 5-day basis, right? This thing went from 170 to 127. That's like a 30% drop. If we have another 30% drop from here, you're in a little bit of trouble. This doesn't look like a company that's doing too well. And you know what? Maybe we could kind of segue this into here as well. Let's take a look at their financials really quickly. So to look up financials, what do? You type in SEC Edgar. That's going to go to the company search page. And I'm going to take a sip of water. This part is optional. And then we're going to type in the name of the ticker. Good questions from Automonia in the Twitch chat. I'll address those in just a minute. So here we go. And you're probably going to look at the 10K, 10Q. We've got a recent quarterly report for the quarter ended. That means this one's quarter ended December 2022. So they probably have another quarterly report coming out pretty soon. But again, you go to the table of contents. And what we want to look at, primarily are the balance sheet and the statement of operations, aka the income statement. So looking at the income statement, these are for the 3 months ended. These are pretty large. These are actually in actuals. You don't see that very often. You normally see these things presented in thousands, but these are actuals. And it looks like there was a $376 million loss last quarter as compared to $156 million the quarter before that. Obviously, that's not very good. If we take a look at the balance sheet, what do we see, right? We see equity at 20 million. Okay, yeah, at least it's not negative. I've definitely seen worse. Current assets, 135 million. They've got cash. Inventory, it looks like a massive amount, and you see this a lot as well with some of these, crappier companies, so to speak. Intangible assets, this could be goodwill, this could be customer contracts, just things that you couldn't actually sell for money in theory, and they're valuing that at $113 million. That's a fourth of their assets. Let me actually zoom in. This looks really zoomed out, I'm sure, from you guys' perspective. So 113 million, which is a fourth of the assets that they report on the balance sheet. We'll pull the chat in here again really quickly. We've got Yeti saying that they're currently not in the best shape, but there was some news about them having been rewarded a $13 million contract, but bearish since they would not be able to produce these EVs. And let's think about what a $13 million contract would do to them, right? Let's say, they make $13 million and it's pure profit. Again, let's go back down to the income statement that we just looked at. $13 million is quite frankly a drop in the bucket for when you have a company that has a net loss of $376 million. Where's their, it's really strange. Where's their income? I mean, where's their revenue? We have expenses. Do they like mess up this filing? Normally at the income statement, you have revenue, you have cost of goods sold that walks down to gross profit. Then you have operating expenses to give you loss from operations. And you kind of have these other items. Interesting. One thing that is, important to note here is that you'll find a lot of times in this kind of other area below the loss from operations, there's some unusual activities. And in viewing a company, viewing their EBITDA, viewing earnings before interest, taxes, depreciation, and amortization. My job deals entirely with EBITDA. I should have not stumbled over that. But in looking at that, you want to exclude those things because it doesn't represent the core activities of a business when you value it. So, for example, if they had a one-time item where they were, had these other financing costs where they lost 255 million on, that's something you maybe would ignore and maybe look closer up here to their loss from operations. However, their loss from operations, even before all of these other items, is still $73.6 million. So again, a $13 million contract is really not going to do anything for them from that regard. What's interesting is that they have literally no revenue. I'm realizing this isn't a mistake. They seem to be a pre-revenue company. So yeah, maybe not something I'd hang my hat on when they're already losing $376 million a quarter, don't have any revenue at all. I mean, is there even a mention of revenue in here? The company, there it is. The company has not generated revenue to date and has accumulated losses since inception. So there you go. This whole risk section is really interesting too, if you really want to start digging into some of these financials. But there you go. It doesn't look great. Anytime I sell a cash secured put on something, I need there to be some sort of redeeming bullish quality about the stock, because when worst comes to worst, what happens? We get assigned shares of a company at a certain price, and we need to make sure that we're comfortable holding shares of a stock at that price. This is not one where I would feel comfortable with that. So, a couple questions from Automonia as well. And again, the first letter of your name's a 3. I don't know how to pronounce that. 3 Eudaimonia? I don't know. Feel free to correct me on that one as well. But are we playing banks the last couple weeks? Answer right there, quite frankly, is no. And the reason being is there's just too much individual eudaimonia. Eudaimonia. Oh, there we go. We nailed it. Now we did. Not before, but eudaimonia. I will remember that. Question about the banks, though. Are we playing individual banks like PACW, PacWest Bancorp? The answer is no. And this is one of those things, you'll see the meme where someone's like looking at something they're not supposed to be looking at, and it's like stocks like this when you are an option seller. There's really no need to get in stocks like this, and they can be so tempting because they dangle this carrot in front of you of these options that offer massive ROR. Like, you could sell a one strike put, basically bet that this bank will exist 5 days from now, and you can make 8% on your money. Like, that's quite frankly insane. However, of course, the big risk is that you find yourself in a situation like SIVB where that number is now 0. So that is what I don't like. What I did kind of propose before, and I did do for a couple of weeks, was instead of taking on an individual bank, was actually playing an ETF like DPST, to get some exposure to some of those banks and get some exposure and have similar opportunity to sell some nice premium. But we kind of take the risk of one or two one-off banks going under off the table. Now, of course, the ROR isn't nearly as nice, but you can still get 3.7% on a 3.5 strike put, which is decently below where this thing has been trading at. You'd have a 340 break even. That doesn't look like the worst idea in the world to me. But again, another thing with these ETFs, if anything really, really did go poorly with these banks, one, the market would have a pretty red day, so the rest of your portfolio would probably be feeling it. And two, leveraged ETFs like this can go under as well. It's obviously a little rarer, and the way that they manage these things, they try to avoid situations like that, but there are situations where if the holdings of the ETF see a certain amount of downward pressure in a certain day or a given week, they could have to liquidate the ETF. So there's still risk that this thing could have that happen. It's just a little bit smaller than the risk that it happens with an individual bank. So do with that as you may. But again, it's just one of those things where I just don't feel it's a risk that's worth taking, right? If we were going to sell 10 of these, we'd make what, $100 off of it, and we'd go to bed every night wondering if the financial system at a regional level is collapsing. Maybe not worth it for me. Another good question: do I think the Activision deal is still going to go through and the UK risk is overblown? I do not think the UK risk is overblown. As someone who personally works in the M&A field and has kind of seen some things like this, legal roadblocks like this can be pretty significant. And there are multiple, phases to this Activision ruling, so to speak. And again, I think this is when that news came out at the end of April. Correct me if I'm wrong. And it can be very tempting to sell premium off that. But one, what we want to remember is I think this is when the news came through, and then this is when the news fell back down. So pre this date, there was all sorts, this is what the company was worth. So as far as investing in this range, I don't have an issue with that. What I do potentially have an issue with is, potentially trying to say, oh, it's going to shoot back up, it's going to go through, because I think the UK thing is a big deal. From what I read about it, there's still a pending US related ruling on the acquisition. So that is still a question mark. But if you have, a country as large as the UK saying no on that, it's very difficult for a company as global as Activision, where you've got people playing their games everywhere from a legal standpoint, to be able to operate independently from that country, if that makes sense. Or at least that's what I read. I'm not a lawyer, but that's kind of my 2 cents and my takeaway from that. But the good part is after this, the risk of that deal going through may kind of be priced in at this point, because it's back where it was before the rumors of the deal were imminent, which I think is interesting as well. Another comment from Yeti saying AMC looks kind of interesting. Let's take a peek. 520, it's at 34 from an RSI perspective. It's, you want to talk about companies that are kind of struggling financially, not even kind of struggling. AMC is not doing very well. This is one. And we've seen in the past, there can be some nasty, I see one, I see a couple right there. 1, 2, 3, and just some decent skids over the last 180 days on AMC. And typically the premium's a little bit higher, right? If we look at implied volatility, it's historically low on a 180-day basis. Now, I never hate the idea of getting in on something, after it's dropped, and two, when the implied volatility is spiking like right around here, because you'll see that often it kind of coincides with a little bit of a short-term bottom. But right now, you don't really have a massive red candle. Implied volatility is very low on a 180-day basis, and consequently, I don't think these puts really offer enough premium to cover the amount of risk that you're potentially taking on. And with what AMC is trying to do with APE, those preferred shares that they've issued, I think the way that equity structure works is they're going to effectively, whether or not it gets allowed or not, try to dilute the hell out of AMC via those APE shares, to raise a little bit of cash and try to stay liquid as a company. So that is what I think about AMC. I think AMC is another one of those stocks that potentially is on a path that looks just like this, if they continue their current business practices. I think AMC is going to go into the gutter one day. I think GameStop is going to go into the gutter one day as well. Bed Bath & Beyond, I said the same thing about. It is in the gutter. It has died. It is bankrupt. But those are some companies that definitely have that on the horizon if they continue financially the way that they are currently on. But there you go. We talked about the credit spreads. Let me pull up what we got for this coming week. We talked about the credit spreads. We talked about, taking profit early. We talked about our week. And all in all, it was a really solid week. $629 is nothing crazy. It's not a massive amount of money. But again, the point is that we're still able, through our strategy, to make money even when the market is either flat or going down. And those are the kind of weeks that are going to set you apart in the long run. So 50 minutes into the stream, let's get to the important part here, right? Let's talk about how we're going to try to replicate or do even better than that this coming week. What do we have set up? What's our plan? How are we going to try to make that money? Let's get into it. So if we take a look, Eudaimonia saying one of those stocks has insurmountable debt, one of those stocks has no debt. Which stock are you referring to that has no debt? Because I'm pretty sure AMC has a substantial amount of debt as well, as does GameStop. Pretty much every company has debt. GameStop has no debt. Good news. We could take a look at this right now. We go to the company filings. We type in GME. GameStop comes up, and we are going to find out exactly how much debt GameStop has. And this is really useful. I think one of the videos I'm potentially going to be making soon is about, things that get parroted online by stocks that kind of have a little bit of a quote, cultish following, so to speak. Bed Bath & Beyond is very guilty of that. Let's go down here. Let's go to financial statements and supplementary data, balance sheets. Boom, here we go. So we go to the liabilities. And again, these amounts are presented in millions. And if we look at current liabilities, they have 1,000 million in current liabilities, which means they have $1.3 billion in liabilities. Now, 531 million of that is AP, 602 is accrued. They have 10 million that's current of long-term debt, and then they have 28 million of long-term debt. If we look down here, they've got some pretty large other liabilities. I'll be interested to see what they're accruing. I wonder if they've got some detail on that. But yeah, from a note perspective, they have the 10.8 plus the 28.7, so like 39, 40-ish million in like actual loans. Let's see what else we've got. Operating lease liabilities, pretty large. It's interesting. Let me double check really quickly what they're accruing for, because the accrued liabilities seem pretty large. Here we go. Warranties, unredeemed customer liabilities. This is probably getting way too technical at this point, but it was just personal curiosity. Subscriptions, 338. Anyways, that's how you view it. But yeah, you're right. They don't have a ton of debt, to be honest. So not a terrible position for them to be in. However, what I do think the issue is, while we're here, is that if you look at their income statement, where is their income statement? It should be under the balance sheet. There we go. Boom, statement of operations. They've got this net loss that's growing and growing and growing. It's great that they have $6 billion in revenue. They have positive gross profit, but they're not getting profitable on a year-over-year basis. So there are a lot of companies like that, but what you'll see in a lot of these companies is very, very swift, either revenue growth or they're cutting that net loss down. Net loss got bigger in 21, went lower in 22, but with flat year-over-year revenue, which is really not what you like to see. Because the whole idea when you value stocks like this is you use some sort of price to earnings ratio, which is the most common way to do it. And you say, hey, this company is worth X times their earnings. And the reason you apply that X to it is because it assumes future growth in the value of the stock. So anytime, year over year, period over period that you're looking at the financial statements, if you see growth that, kind of ceases to exist, that's a big cause for concern. Now, I know they've got all this retooling. They're trying to, change the way that they operate. So we'll see how that works. But as of right now, it doesn't look like a company that has a great future. Now, if they come out with financials where revenue's gone up again, they've improved their margins, they're, inching closer to a potential gain, that's an interesting conversation. But as the numbers currently exist right now, it just doesn't look too great from that perspective. So, with that said, again, that's a $313 million loss. And if we go back to their balance sheet, they've got 2.3. They got a decent amount of cash to cover that. They're fairly liquid, to be honest with you. Not nearly as concerning as Bed Bath & Beyond was or as AMC is. So financial position is definitely a little bit better than it was before. So we'll see. They've definitely bought themselves time. I don't think bankruptcy is imminent like it was with Bed Bath & Beyond. But that's interesting. I haven't looked at those in a while. But back to where we were. Let's talk about what we've got top to bottom. Macy's. This is a position that we've been rolling week after week after week. And Macy's, we like Macy's right now because of where it sits from an RSI perspective on a 1 year basis. Sorry, that was 1 day. 1 year basis, it's in the blue. And right, it's not always going to coincide with the bottom. If that did, investing would be way too easy. I'd leverage my entire account and just buy shares of anything that ever went into the blue from an RSI perspective. But we're getting this nice intersection of one, blue on RSI, and two, a little bit of increase in implied volatility, and three, a little bit of a longer term level of support around 15 a share, and it closed at 14.99. So we're hoping we can catch a little bit of a bounce right there. But larger point is that we started Macy's a couple weeks ago. We started it with the stock above $16 a share. We took a decent hit the first week, but we averaged in, right? 315 loss on the initial position, but with the two things we averaged in with, got dropped down to 245. Last week we made only $80 off of it. But this coming week, if it goes back above 15, we make 215, and all of a sudden, boom. Another example of us taking a trade that's a loser into a potentially winning trade if it stays above 15. Have we looked at DDS? Let's take a look at DDS. What's DDS? Is that like Dillard's? It is Dillard's. Boom. Retail knowledge off the charts. But yeah, decent, I guess. I mean, it's still a little bit elevated here. You've got implied volatility dropping off the face of the earth, which is very, very strange. I imagine it's not very liquid. It is not very liquid, not a ton of volume right there. A little bit of precedent for it to go a little bit lower. Like on a 3-year basis, this thing's pretty elevated. I don't know why. I don't know what's causing this thing to show as negative at some point back in 2020. It must be the dividend. The special dividends. Gotcha. That makes a little bit more sense. But yeah, it's a little bit scary of a longer term chart. Whereas Macy's, boom, we've got some longer term established support. Yeah, it got pretty rough down in COVID. A lot of retail did, but I like the level right here because not only do we see a jump off of it back in September, October last year, but we also see it bounce off of that level a little bit in 2021, both in March, April, and mid-July. So definitely some precedent for a bounce off of that 15-ish level. So I like it from a technical perspective. We're rocking with that one. Shake Shack, like we talked about earlier, we rolled that one into the following week. We're going to continue to manage it that way. RCL, very similar position. This one, we didn't have to do too much. We were in a position where we lost $63, right? We had to do some management and wiggle around a little bit to lose 86 on Shake Shack. RCL, we took it a little bit easier, took hands off the wheel, and only lost 63. So we rolled it into next week where we can make 162, and all of a sudden, boom, it could be a $100 gain. PHM, this is one that I opened pretty strictly off of RSI. I don't know a ton about Pulte Homes, but it looks like it's running up a ton. What I do love, this is a 3-year chart, right? This isn't a stock that looks like it's about to have some huge short squeeze against it. It pays a dividend. Decently solid stock. Nothing too crazy to say about it. But on a 1-year basis, boom, 78.80. That's a very, very large number. So what we did was take maybe a little bit more aggressive of a credit spread by selling a 68.5 short leg, which is right around where it finished. But again, remembering that even though our short leg represents our max profit point, and that may be kind of around where the stock is trading, our overall break even is going to be 68.5, that short leg, plus 0.47. So anything below 68.97 on Pulte Homes this week is going to make us money. So 68.97 is right here. And guess what that coincides with? Boom, the top from Friday. So I was happy with selling that. This is the 5-day chart. While it is a little bit, up and down, maybe a buck or two at a time, nothing crazy volatile. And I think I'm happy with this level right here to play it down from. Again, we could do what we talked about with the Shake Shack credit spread, where we could take the top off and manage it and just kind of turn it into a pure short position. But from a technical perspective, I love playing anything down from 78-ish, right? The last time I got up near 80 Well, it did continue up after. There is this red candle from 67 down to 65. That kind of $2 drop, if we did see another instance of that, would be plenty for us to take some early profit on this one. Good Lord, my nose itches. But I think those are the extent of our credit spreads for the coming week. Peloton, we're getting back in. We sold a little bit of an aggressive strike on that one. And the reason being is we're back in at half price. This thing's at 29.28 RSI. We entered Friday, kind of midday-ish when it was at 6.80. We got a little bit of a run-up towards the end of the day, which was nice. But we sold the in-the-money 7-strike put because of max profit if it pops all the way back up. And I totally mistyped. It's about $200 of profit. So nice return from an ROR perspective, definitely on, if you get 39 cents on a 7-strike put. SPXU, we've been running this one week after week after week after week. We've started with the half-size position. We've actually never even needed to go above a half-size position. This thing's been hanging around 13.5 for so long. We're going to take 170 of profit from the calls this week. Last week, where is SPXU? We got $30 of profit off of them because we made a little bit of cash off the shares. The week before, we made $95 of profit off the 13.5s. The week before that, we made 115 off the 13.5s. We did the 13.5s again the week before that for another 115. And then we did them again for 200. Did we do them the week before that? Yeah, we did the 13.5s again. So from these 13.5 strike calls, literally since the beginning of April, we've made $870 of premium from it. All from it just kind of staying flat. And the great part about this is if it shoots back up, that means the market's going down. This is a hedge to our account. Eudaimonia question in the chat about IEP after the Hindenburg short report. Yeah, I thought it was a very interesting short report. I think the opportunity is a little bit gone though, because I think off these big initial red candles, you kind of either do or you don't get in on it, right? Off this big initial dip, it's tough. Dividendo, Faux Life, what's going on, man, in the YouTube chat? Yeah, it's crazy. Hindenburg's doubling down. They're doubling down. What I thought was, maybe most scathing in the report was about the net asset value that IEP was trading at. It was trading at like 200-ish%, when some of these other similar funds are around like 100, and very few are above 100. People are almost paying a 2x premium on the assets they're holding just to be, with Carl Icahn. So I thought that was kind of bad, and I thought a great idea off the initial dip was to say, hey, when this thing was at 50, 25 would be net asset value. So what could you do? You could sell a 25 strike put. However, all the stuff so far out of the money was so juiced that the short reports don't come from nothing, right? So if something did happen and it got crushed and they went under, I don't want to lose all my cash on that. And I wanted to make a spread, but literally every single strike, the premium on it was so juiced that there wasn't really an effective way to make a spread. So I just kind of sat that one out. It would have been great if I sold a bunch of 20 strikes for May 19. That would have been tight. Those got up to, I think, $1 at one point. It was very interesting watching the premium on those. But sitting that one out, one of those that's fun to look but not touch in case you get bored with your nice, smarter trades during the week. Petty Bourgeois asking if we have any thoughts about MLKN. Had some bad press recently with the Pity City thing, but there's a pretty strong dividend and the company is profitable. Let me throw that on the chat, or the screen, the TV, whatever. I'm losing my mind. So you guys can see it, but boom. MLKN. Herman Miller. Oh, I didn't even know they had a stock. I got one of their shares right now. I love it. It's fantastic. So I would recommend you buy. But more seriously, 1 year chart, decent. Pity City CEO. Honestly, I haven't heard about this Pity City story. Andy Owen, CEO of MillerKnoll Inc., drew backlash for her response to employees' concerns about their bonuses. Many employees, yeah, you got the Aeron. Oh, this is the Aeron as well. It's great. I dumped some other chair for it. My back feels great. Back to the point. Many employees are seeing their bonuses reduced or eliminated, but the ones at a Michigan-based furniture company whose chief executive asked them to leave Pity City in a now viral video may be getting the most sympathy, at least online. So basically an out-of-touch CEO getting some bad press. Wow, okay. But should that impact their stock price is the big question. We look at this maybe on a 3-year basis. Let's back out even further. This looks like a fantastic place to get in. But if we're trying to, maybe catch a knife, so to speak, with some of this option selling, another thing that's fantastic for us to do is crack back into the financials. And I think the one thing you could lean on best is, hey, is this company making money? And let's take a look really quickly. Let's take a look very quickly. And I think we could actually probably do this a little faster by going to analyze, going to fundamentals, and then typing in, shoot, what was the ticker? MLKN. We can go down here and look at the earnings per share, and it looks like they're losing a little bit of money, which would obviously make sense with the big drop in the price. Still pay a dividend that's higher than the earning, or higher than the loss per share, that is. Let's see, and the dividends increased a little bit over time per share. PE ratio, their current is 17.66. That's really not that bad. Let's look at revenue here. What's revenue? Where was revenue? Do they have revenue? We can't see it year over year. It's currently 22. Average was 15, so it's growing. I don't think this is that bad. All these quick valuation metrics here are also very, very helpful. Pretty low price to book value. Decent place to get in, but now the big $1 million question is, what does the option premium look like? And the issue here is that there really isn't a ton, right? If you want to do the longer date cash secured put approach, I'd suggest doing that on a stock where implied volatility is shooting up a little bit. This is not that. In fact, it's kind of low on a 1-year basis. But if you wanted to play that game, there isn't even a July expiry, so that makes that especially difficult. But if you want to go to June or something, it's only a 3% return for like 4 or 5 weeks. That's less than 1% ROR per week. And you're only getting in at like a, 1460-ish break even, which is, okay. But is it worth the risk if something crazy happens? There's just not a ton of liquidity. Implied volatility is a little bit depressed right now. I'd maybe stay away from this one, but another one to potentially keep on the watch list, because if it continues to drop, gets down to 15, then you could say, okay, boom, we know 1523 is the 1-year low. If it gets down to 1523, I imagine those 15 strike puts are going to have a lot more premium on them than they do right now with the stock at 1631, and you can move from there. Question from, I got to get this chat working on the screen again. DVN Energy stock. Energy is a very interesting area right there, or recently. What am I talking about? Devon Energy Corp. A lot of these 3-year charts, exactly what I suspected. These things have run like crazy since COVID and are now kind of falling back down. This is a chart pattern that really, really scares me. Because when you look at these things on a 1-year basis, it looks great, right? It's almost approaching oversold territory. You've got 44 as a low. It's kind of at this level of support that it bounced off of last July. Something very, very similar like with Enphase on a 1-year basis. Enphase looks fantastic. But if you back out to the 3-year chart, boom, a little scarier, right? You've got a stock that went from a low of 37.81 up to 167.55. That's a little bit more exaggerated than what we see with maybe it's not a little bit more exaggerated. DVN like 7x as well. Long story short, I've typically found that these setups, while they may work on a week-to-week basis, if things really do move against us, what's the one thing we count on? We count on owning the stock and being able to cushion ourselves on the way back down. If these things really start moving back down quickly and get back even down to this mid-20s level, that's going to be very, very hard to keep up with. I mean, if we're looking at this thing, that you can't find more than 1% ROR slightly out of the money, so I don't even know if that's enough potentially to comfort a potential dive. At the very least, these things do have much better liquidity. They've got weekly options, but to me, the reward is not necessarily worth the risk in setups like this. I do say that I do have a position on BE, but if we look at BE, Bloom Energy, boom, this is a much better 3-year chart. This thing did go from 764 to 44.95, but now it's fallen back down. We were at 1272 off some tough earnings, but this 1272 range looks a lot better if you're looking for an energy type stock to be playing. What's great about this, you could already see that we've got a position on the 12 strike puts, but these are offering 1.69% ROR on a weekly basis. There are monthly options. We could potentially look into selling something a little bit longer dated after this week, but I really like where this stands, one, from a technical perspective, because it is a 1-year low right now, and two, RSI is down at 22.59. Very, very rarely do you find RSI like that. And if we take a look at the news, we'll probably see some analyst price targets. Boom. You've got a price target from Wells Fargo at $20 a share. You've got a price target from Baird at 21. Oh, J Mart's in the YouTube chat, man. Where you been? Oh, it's been so long, man. We've just for proof to show J March, for those of you who have been with us for a while, is making his reappearance tonight, 10:08 p.m. Eastern at 5 on May 14th, 2023. We've got to document this huge achievement. I hope you've been doing well, man. Long time no talk. But finishing out the point on Bloom Energy, boom, Truist, $20 price target. Baird has a price target of $21 a share. So we've got a lot of upside from the analysts that cover this, and we're in at a very, very nice point. I mean, this is almost one where I feel like we'll look back 2 or 3 weeks from now and be like, damn, this setup was so good that we should have just bought the shares and held until it bounced to 15 plus. However, that's not what we do, because more often than not, I feel like we run into situations where it's like, damn, this thing kept going down. And we are glad that we played it the way that we did, because we're able to kind of cushion and comfort that fall a little bit. So again, kind of back into the theme of what we've got for next week. Bloom Energy, boom, right there, 12 strike put, trying to bag $125 off of it. And again, we've sold 5 contracts. It's 2.12, or it's not 2.12. These are wrong. Ignore those over there. But it's a very, very small percentage of our account. We could easily scale a little bit further into those. But now to address J Martz, who has made his reemergence tonight. Will we be playing any of the retail giant reporting earnings this week? And to me, I don't love the retail earnings. I feel like those are so frequently underpriced. Like, you either get a move where it's nothing, or you get a move where it's like, oh my goodness, this stock is doing terribly. Like, I feel like off the top of my head, Target's a great example of that, where like you have all of these instances of nothing happening on earnings. Then all of a sudden, boom, back in November of last year, it goes from 179 to like 150. And if you had put options there, if you sold them, you got cleaned out. Now, longer term, obviously, these are much more stable types of stocks. Oh, yeah, here we go. Even at the beginning, I almost missed it right there. You've got a drop from 211 to 161. The thing dropped like 20-30% overnight on an earnings call. Whereas we've got another earnings here where nothing happened at all. So, this is like, I caution, I almost want to stop myself from saying this, but they're almost biotechy in that regard, where it's great if nothing happens, but the alternative when something crazy happens is really just not, like, you don't want to be on the wrong end of that candle. Now, you could make the point that, hey, look, on a 3-year basis, this thing's trading at a decent level. We go over to the Analyze tab, type in Target, and we could pop back down to those valuation metrics again. Yeah, Target, the legendary biotech stock. Don't quote me on that. But look, the PE ratio right now is still 26. We know the S&P 500 average is in the low 20s right now, so there's definitely a little bit of potential downside right there, right? If it were in line with the market and had a PE of like 21, that'd be a 5 divided by 26. It'd be a 19% drop on the stock. So if we do 1 minus 0.19, excuse me, 1 minus 0.19, it means it'd be 81% of the current price. So 0.81 times 157.99. The stock could be trading for 127.97 if it were valued similarly to the S&P 500. So that's a decent drop right there. And you'll see that that kind of coincides with where it started to bottom out and run post-COVID. So just something to keep an eye on. I don't love the value of something like a Target, and typically valuation is so important come earnings time. And guidance even more so, but we'll see how these play out. I'm much happier to potentially sit back, wait, and if we see a big red candle like this, let's react and then try to scoop in with the big spike in implied volatility and set ourselves up in a trade in that way. But we're past 10 o'clock here on the East Coast, the Night Owls, if you guys are up with me. Let's finish out what we've got for this week. We've got X Steel Company. We swooped in on that one at the end of last week. We hit, oh, that's wrong. That's not 0. We rolled it for a credit. We closed this for 0.04. Bad news. We made less money than we thought, but we got to be accurate. Anyways, we rolled it for a credit and got into next week at 40 cents. So $160 if that thing stays above 21. MOS, this is one we've kind of tried to roll with a little bit on a week-to-week basis. Very, very similar to Penn with what happened last week and the fact that we started with the half-size position, moved against us. Both positions lost money, and we're sitting on a 231 loss headed into the next week. But MOS is sitting at 35.35, and at that current level, we will make 111 plus 195, and it'll net out to an overall gain. So we're happy with how we rolled it. And the good part about MLS is we've talked about PE ratio. We go to the Analyze tab and we look at something like Target where it's a 26 PE ratio. MLS, we go to the bottom of this tab. What we're going to see, and this is live, so I could be entirely wrong. Boom. PE ratio of 4.87. Now, why is that so low? You may say, okay, the S&P 500 is like 20. This is crazy low. And the answer is because of the nature of the stock. And if you go up here, it is a materials company, right? Concentrated phosphate and potash crop nutrients, agriculture stock. It's been much lower. It's been much higher, but this seems like a decent level to kind of start to initiate a little bit of a position, especially with the valuation they have as it currently sits, right? Earnings per share on a 5-year basis, really, really jumping up here. And at the very core, which is what's great about using earnings per share, using the price to earnings ratio, at the very core of everything, what is a stock intrinsically worth? And the answer is earnings. So this thing's worth at least $10 since it's got $10 a share of earnings, right? Book value sitting at $35.55, which is almost right where it's at. I love the value on this one, and there's a really nice amount of, option premium on it. That's not it. That was weird. There's a really nice amount of option premium on it as well. So we're happy to be a little bit more aggressive with these strikes. Start to scale in. We started with 3, we went to 6, so in theory 6 is a full-size position, but at the same time, I can go a little bit further in just because of what we talked about. I think it's inherently a little bit lower risk in this mid to low 30s level due to that price to earnings ratio. And you may say, oh, HT, back in 2020, this thing was trading at $10. But if we look back at 2020, earnings per share was $1.69. They've 10x'd that, right? They've been crushing it. So that's what we got there, and that kind of rounds out a little bit what we've got. We've got an XSP Strangle, we've got the pen position, we've got Bloom Energy, which we've talked about. So all of which, the way that we evaluate these things, if all of these stocks neither went up nor went down, they stayed exactly where they're at, we would make $2,194 next week. Typically, we start there, and then as this number gets smaller and smaller and smaller, we try to manage the positions to try to push it back up a little bit higher and higher and higher. And go from there. But a great place, I think, to start out with the 1.15%, what we call base return headed into the week. So boom, there you have it. We have made it through another weekly stream. We recapped last week. We talked a little bit about what you guys had for us in the chat. So appreciate those of you who were active in that and, going back and forth tonight, because without that, I'm kind of just in the corner of my bedroom talking to myself. Some would call some who do that a maniac. So hopefully I'm not that much of a maniac. You guys helped me stray away from that a little bit. We did not quite hit 30 live viewers. We didn't have the graphics working tonight. That was kind of one of the casualties of the technical issues we had. So there was no giveaway of the HT tumbler. I get to hold on to this another week. And of course, you're not getting the one that I'm actively drinking out of. You get the brand new one, which is conveniently right here. But we got kind of close tonight. We got a little bit over 20 at a point. So I think if I continue to, be a little bit more diligent in making content and putting my stuff out there, we can get to 30, and one of you could be the proud owner of one of those tumblers. And Ted, if you are watching this and still up, I need to send you one. So that has not slipped my mind either. But until next time, this has been the Hourglass Trader, where as time passes, we make money. I've got to sign off with the corny intro. I feel like it's good luck. Every time we do it, we have a pretty solid week, which means me saying that out loud and putting that out there probably jinxed it. But again, thanks so much to all you guys who tune in, not just tonight, but every night, sticking with us in the Discord server, hourglasstrader.com. We are on the web. If you want to join our Discord server, there's a big purple button in the middle of our homepage where you could go ahead and do that and talk with us on a week-to-week basis. But until next time, that's all we've got. Happy Mother's Day if you are one of the HT moms in here. Shout out to the HT moms. Now that's officially all I've got. So again, thanks so much to you guys spending your Sunday night with me. And we will talk again next